Morning students, I welcome you for the online class of business studies. Today we will be going to learn the sources of business finance continuation we will be doing. Here we will have already learned the public deposit. Let us have a recall of that. Public deposit, what we have learned. It is a type of borrowed fund, medium term finance. What can be done? Public deposit is a way of inviting the general public to invest in the shares of government company. It is generally done by the government company, not by the private sector. They publish the invitation in the newspaper. Those people who are having a trust over the public company, they will be coming forward to invest in that public company. But guarantee is not that money company will be giving the money back. But still company people invest in that company. Characteristics of public company, what we have learned. It is unsecured. Companies mortgage no asset against the public deposit raised from the general public. Finance of working capital. The amount raised from public deposit is generally used by the company for meeting the requirement of working capital. Though there are a primary source of short-term finance, but by renewing, this can be used for medium-term also. Time period. Generally, public deposit is invited for a period of 6 months to 3 years. Simple procedure to raise. Yes, it is a very simple procedure as in the newspaper advertisement is done. Public deposit are simple to raise. A company simply has to place an advertisement in the newspaper. Any member of the public can deposit money with the company by filling a prescribed form. The company issues a deposit receipt in return, and on the reverse of the receipt, the terms and conditions of the deposits are mentioned. Repayment. A company which has public deposit is required to set aside 10% of the deposit maturing by the end of the year. The amount so set aside can be used for repaying public deposits. Merits advantages of public deposit has been learned. The very first merit is simple procedure. Yes, it is a very simple procedure. Has if we want to increase the amount of capital in the form of public deposit, the company have to give mere advertisement in the newspaper. The procedure for obtaining public deposit is much simpler than equity and debenture issue. For obtaining public deposit, company do not take permission from the controller of capital, and there is no need to get listed in any stock exchange market. Economical. Obtaining public deposit involves very less cost. Companies don't need to spend on prospectus and underwriters commission. There are very few administrative costs involved in the obtaining public deposit. The interest paid on public deposit is less than the interest paid on debentures and loans. No security. Public deposits are unsecured, so the assets of the company are free to be used as mortgage in future. Reduction in tax liability. Interest paid in the public deposit is deducted from the total income of the company. Hence, it brings in helps in bringing down the tax liability. So that point of view, it is very beneficial because from tax it is deducted means a part of income will be reduced just because of the public deposits. Flexibility. Public deposit can be repaid when they are not required. Therefore, public deposit introduces flexibility in the financial structure of the company. That's why it is showing flexibility, which is an advantageous point. No dilution of control. Public depositors have no voting rights as they are just a like debenture holder. They will be investing in the company, but they are not sharing any ownership like. They cannot influence the decisions of the company. There is no dilution of shareholders control. Demerits, disadvantages of public deposit. When we learn the following are the disadvantages of public deposit. The very first, raising finance through public deposit suffer from the following limitations. Very first, limited amount. The amount of fund that can be raised by way of public deposit is limited because of legal restrictions. Public deposits cannot exceed 25% of share capital and free reserves. Uncertainty. Public deposit is an uncertain and unreliable source of income. And during depression period, the depositor may not respond. Also, deposits may be withdrawn whenever the financial position of the company is not stable. Suitable for short-term finance. A company cannot depend upon the public deposit for a long-term financing requirement as the maturity period of public deposit is between 6 months to 3 years. Hinders to growth of capital market. Public deposits hamper the growth of a healthy capital market in the country. Widespread use of public deposit creates a shortage of industrial securities. So public deposit hamper the growth of a healthy capital market in the country because it will not make the market share to be grown. Or widespread use of public deposit creates a shortage of industrial securities means shares of the private company will not be demanded because public interest will be in the public deposits of the government company. So private company will feel difficult to accumulate the share amount, not suitable for new concerns. New company do not have enough goodwill in the market. The advertisement given by new company do not attract many people to invest money in their public deposits. Suitable for conservative investors only. Public deposits do not attract bold and adventurous investors who want capital gains. Only cautious and conservative investors prefer to invest in public deposits. Issue of shares, owners fund, long-term source of finance. Issue of shares can be done. Issue of shares. Share is a owner's fund and it is a long-term source of finance. Share is the smallest unit in which owner's capital of the company is divided. A share is the interest of the shareholders in the company, measured by a sum of money for the purpose of liability and interest. A share may also be defined as a unit of measure of a shareholder's interest in the company. So share has the whole capital divided into small parts. It is known as share. The person purchasing the share is known as a shareholder, and the money is measured in by a sum of money for the purpose of liability and interest. According to Companies Act, a public company can issue two types of shares: equity shares and preference shares. When we say about the equity shares, it is a common security issued under permanent owners fund capital. Equity shares are the most important source of raising long-term capital. The equity shares are those shares which do not carry any special or preferential rights in the payment of annual dividend or repayment of capital. Means whatever profit is earned by the company after clearing off all the creditors' payment and all the liabilities of the company first will be given to preference shares, then it will comes to equity shareholder. The last income of the company is given to the equity shareholders. At the time of winding up also, capital of equity shareholders is returned only after paying off every claim and settling after every money problems. Prior to the year 2000, the companies were allowed to issue equity shares with equal rights only. In the year 2000, an amendment was made in a Companies Act permitting companies to issue two categories of equity shares. Very first, equity shares with equal rights, and second, equity shares with differential right has to be divided. Features of equity shares: when we see the primary risk bearers. The equity shareholders are the primary risk bearers of the company. In case the company suffers losses, then equity shareholders have to bear the loss. The due payment is given to creditors before paying the equity shareholders. Claim over residual income. As I already introduced to you, after paying all the people, the rest of part of the income goes to equity shareholder. That is the residual income. So the equity shareholders have claim over the leftover income of the company only. They get share in the income left after satisfying the claims of all creditors, outsiders, and preference shareholders. Basis for loan. As much the number of equity shareholders will be there, equity share capital is the basis on which loans can be raised. The amount of equity share capital adds to the credibility of the company. The amount of equity share capital increases the confidence of the peoples and the creditors. Control. This is also a best part. Equity shareholders have control over the activities of the company. The equity shareholders have voting rights. The equity shareholder cast vote to select the board of directors who control and manage the affairs of the company. Higher profit. The rate of interest for debenture holders and the rate of dividend for preference shareholders are fixed. At the time of profit, the debenture holders and preference shareholders get profit fixed income only, but equity shareholders enjoys a higher profit. Next, preemptive rights. When we talk about preemptive rights, this is the very good the feature of the equity shareholder, which give preference to the equity shareholder for every new shares. If the company want to issue new shares in the market, first they will be giving opportunity to the existing equity shareholders to purchase the shares. If they will not be purchasing the shares, if they will not deny for purchasing, then it will be going to the market. So that right is known as preemptive rights. The equity shareholders are given preemptive right by provision of Companies Act. According to this right, whenever a company is planning to issue new equity shares, it must offer the shares to the existing shareholder first. If existing shareholder refuse to pay by the new issue, then only a company shall offer these shares to the general public. This right protects the controlling rights of equity shareholders. Now comes merits advantages of equity shares. When we see the merits and advantages of equity shares, there are as follows. From the company's point of view, there are several merits of issuing equity shares to raise long-term finance. These are: very first, the permanent capital. Equity shareholders provide the permanent funds of a company. There is no fixed commitment to return the money to pay a fixed rate of dividend. No charge on fixed assets. For issue of equity shares, a company is not required to mortgage its assets. The assets remain free for borrowing loans. Means the, the equity shareholder cannot claim over the property of the company. While the winding up of the company also, they will be getting the last part of the share of the company. High credit standing. The amount of equity shares in the capital structure determines the creditworthiness of the company. As much the number of equity shareholder will be there, that must be the creditworthiness. The company will enjoy the higher creditworthiness. Huge funds. By issue of equity shares, a company can raise a huge amount of funds because the denomination of equity shares is very small. People from all income groups can invest in equity share capital, so a company can mobilize huge funds from investors belonging to different income groups. Next is demerit disadvantages of equity shares. Following are the demerits or the disadvantages of equity shares. The very first, risk of fluctuating returns. Equity shareholders sink and swim according to the company. At the time of adversity, equity shareholders have to suffer loss and get no return or a very low return. Some of the years there will not be getting any profit if the company is going through the depression period. Inflexibility cannot be returned. Definitely students, equity shares once purchased, it cannot be returned. It is a permanent source of capital. It cannot be returned even when it is lying idle. When there is no scope of expansion or growth, then the equity share capital remains idle, but it cannot be returned during the lifetime of the company. Legal formalities. A company has to complete too many legal formalities and has to take many permissions before issue of equity shares to the general public. So there are a long lasting formalities which has to be fulfilled for issuing and selling the equity shares. Issue depends on market condition. Definitely the issue of equity shares capital depends upon the market conditions. Equity shares are risky securities, so these are demanded during boom period only. During depression period or recession period, people hesitate to invest in capital in equity share capital. Very second comes preference shares. Preference shares are the as there are having the pre-rights over the shares. First rights over the dividend that has compared to equity shareholder. That's why their name is given as preference shares. It is also an owner's fund and it is also having long-term finance. Preference shares are those shares which get preference over equity shares in respect to very first payment of dividend, second repayment of investment amount during winding up. So they will be getting, as compared to equity share, they will be getting the first part of the dividend, and second thing, the repayment of investment amount during the winding up also will be done to first preference share, then to the equity share. So they are having more preference, but in management point of view, equity shareholder has having more rights as compared to preference shares. Features of preference shares we will be going to learn in the next chapter, next class. Today I want to recall once again the points and the features of the equity shares. Equity shares, when we talk students, the very first, the features of equity shares what we have learned: primary risk bearers, claim over residual income of the business, basis for loan, control, higher profit, preemptive right. These are the features of equity shares. When we went to various advantages of equity shares, we have learned there are the permanent source of capital. There is no fixed charge. There is no mortgage against the fixed assets over the equity shares. High credit standing. Creditworthiness of the company is good if they are having higher number of equity shareholders. Huge fund. By the way of a equity share, company can associate more funds in the company. Demerits, when we have learned risk of fluctuating return is there, inflexibility is there, legal formalities are more, issue depends on market conditions. Then we have learned the meaning of preference shares. It is also an owner's fund, long-term finance. It is having two rights over the equity shares. What is over the payment of dividend, and second is repayment of investment amount during the winding up. For today's class, this much only. I hope you have understood. Thank you for today's class. Have a nice day.